Hey everyone, it's Kyla. Welcome to my channel where I talk about the stock market and the economy, amongst other things. Today I'm going to do something a little bit different. So I tend to really focus on talking about, whether it be single stocks or like macro trends. I kind of wanted to do a piece that just is sort of meta. So the way that I have been thinking about all the things that have happened, especially in the past 24 hours, is through the concept of a traffic light. Last week I really talked about what was happening mostly in the crypto space, and now I want to talk about why things happen from my point of view. And I think that there's three levels to this traffic light. There's the distributors, which are SPACs and Amazon, and then there's the platforms, which would be OnlyFans, and then there's the individual, so you and I. And also as like a brief update from me, I'm in my new apartment. My downstairs neighbor slid a note under the door and said I was stomping too loud. So that like shook me up. But like, how do you walk soft? I don't know. And it's like an old building. So I'm like, oh, I've made an enemy. Let's get into this traffic light. That's way more interesting than me. There's distributors, which are SPACs, so special purpose acquisition trusts. I wrote about SPACs a little bit back in January in my stonks piece, and basically I see them as memes that are investable narratives. SPACs are tools. They're financially engineered products that can be multi-purposed. Sometimes they're an investment opportunity, but sometimes they're used to simply shift risk. They are truly investing on hope in a way that transcends the usual pre-revenue tech investment. Memes are visual narratives. SPACs are investable narratives. Justin had a really good tweet about this. SPACs have always been the underbelly. This last hype cycle was just the collective marketing, putting lipstick on a pig and selling it. All the early horses out of the gate pulled it off, but from here out, it's ugly. The SPACs just seem to SPAC whatever they want to SPAC, and there's also a fire alarm problem here, like a fire truck problem here. So sorry about the sirens. It goes down into a get rich quick scheme for the hedge funds and others during the redemption phase, where hedge funds can either pull out or continue going on, which they tend to pull out because it's usually not that great of a deal. SPACs really just are not good distribution tools. And there's a couple of variables behind that. So with the hype cycle, the SEC literally had to step in and warn people not to join a SPAC because so many celebrities were forming their own. And then with risk reallocation, sometimes the SPACs can be used to pay down debt, and that shifts the risk of a leveraged SPAC in the lone investor to the individual investor. With sponsor incentives, SPACs are popular because it's an easy way to get paid as a sponsor, and they earn about 20% of the equity independent of deal outcome, which is where things get really dicey. So you're still gonna make 20% upside even if the deal goes really poorly. Like, okay, sure, like I'll SPAC whatever you want me to. I'll SPAC these sirens into existence. And then there's supply and demand. So supply of companies, there's only so many companies that want to go public and only so many companies that want to go SPAC. And I think there's like 400 SPACs like looking to SPAC a company, and there was like 423 IPOs in 2020. So they're just like really trying their best to SPAC a company. And because of that, there's the supply and demand misbalance, and the demand of SPACs can lead to lack of choice, leading to bad decisions, which sounds familiar. And then there's also bad companies. So because of this combination supply and demand misbalance, the incentives of sponsors and the potential for SPACs to simply be a way to shoulder off risk, sometimes bad companies do get SPAC'd, believe it or not. Crazy, I know. SPACs are more so a signal to the broad market that they're a narrative, they're a way for companies to get access to money, and they're a way for the investors to make money. So it's like, SPACs are really just like, it's like, okay, they're really just, it's not really just an investment vehicle going on here. And then you got Bill Ackman getting sued for his SPAC. So I think we're gonna see a lot of fallout in the SPAC space. But my main point here is that SPACs really did seem like this awesome idea. Like, okay, like retail investors can get in on, these companies going public. It's an easier way for these companies to go public, and SPACs have been around forever. But boiled down, it's just really this combination of FOMO. So the companies do want to go public, but they're also like, I don't want to pay to go public. They get rich quick, so the hedge funds love this kind of thing because they can take their money and leave. And it's signaling, propping up a product. So come join our SPAC, come invest in our SPAC. It's like cool and new and unique, and it never boils down to be that way. And then the next iteration of distributors in signaling is Amazon just announced that they would be opening up their own department stores. Which is kind of funny because everything seems to loop back to the same point in time eventually. And then the question becomes, well, is Amazon the next Sears? Mostly Borrowed Ideas had a really good tweet about this from Benedict Evans. Amazon is so new and so dramatic in its speed and scale and aggression that we can easily forget how many of the things that we're doing is pretty old. Amazon is not like really creating a new car in the retail sales space. They're just more so like putting new wheels on the car. And now they're returning to the roots of commerce by opening up their own stores. Sears had a really similar path. They began by selling watches, so in Amazon's case that'd be books, by mail order, and then sounds familiar, and then they got that really big catalog. Amazon got that really big website, and then they sold to everybody. Amazon sells to everybody. 1/3 of all US workers had a Sears credit card in the 1960s. That's huge penetration of a population, considering that it wasn't as accessible as Amazon is. So Sears was it for a bit, and Amazon is it right now. But Sears was the American dream. And Amazon, I think, is a manifestation of the internet dream, so the Web 2 dream. Sears was that version from the early 1960s onward. Amazon is that version now. So Amazon is really like this internet dream manifested for a lot of people. Obviously, Amazon has AWS, like I said. And why are they going back into physical retail stores? Mostly for distribution, more goods, more money, more people. Also growth, see above. And for fun, because they destroyed the mall, they now want to become the mall. Like, why not? Why not, honestly? I think a lot of this does boil down into like how people are acting right now. So behavioral psychology, people want to go hang out because despite society becoming decentralized, we genuinely crave this tangibility and accessibility to other humans. And that's why Amazon is doing this. It's a signal, right? They're signaling that they're a place where you can go and, get everything done. You can still get your same day shipping, but also you can go hang out with Amazon. It's, it's a retail distribution center, but like the IKEA model, right? Like I could see them hacking into that, like come try all our random weird products. Why not? And getting into platforms, so OnlyFans, just like SPACs, OnlyFans are also questioning their whole business model. OnlyFans is barring sexually explicit videos starting in October. And this seems to be mostly because they are struggling with raising money from investors. So investors are worried about the reputation of the brand, and also minors having access to the product, which are very valid concerns. And then also card processing companies are they've been denied by I think a lot of merchants. There's SESTA and FOSTA laws, which I think is how it's pronounced. The Stop Enabling Sex Traffickers Act, that tends to bite into what the card processors can do, and that can prevent obviously OnlyFans from executing on the business model, because there's that big question of like who's actually doing what on the platform. And then there's moderation concerns, especially around these underage users. Then the moderation concern needs to get figured out, like there's no question about that, but this blanket ban does create a lot of problems, mostly for the creators, in the form of lost income. The whole thing felt very rushed, and there's still a lot of stigma around this sort of content. And the weirdest thing is like OnlyFans does make a lot of money. Their revenue was $375 million in 2020 and $2.5 billion in 2022. Expected. Free cash flow is strong. Their user base is sticky. Their growth is incredible. Like any other company that had these metrics would have an overflowing cap table, and it'd be like a fight to the bone to try and get access. But because it's OnlyFans and it's because of the business model that they have, it's not the same structure. They have to change their whole business model to get money. And crypto does have a role here, and there's a lot of crypto payment apps like SpankPay and other things. Little pieces about how we're a society living in this combination of signaling and status. Sex work, explicitity is meant to be kept under wraps to a certain extent. It's really tough to like parse through exactly what that means. Like, why is it kept under wraps? And obviously there's like huge pointers in either direction. I'm not going to dive into that because that's outside of my domain. But markets, like, not to get all finance bro, but markets are a reflection of behavior. OnlyFans they have problems. They need to work them out. But this gets into the fine lines of signaling. Capital, so money from investors, strong backing from investors, having those key people on your cap table. It's a key that unlocks a door of possibility. OnlyFans is doing this because they have problems with the merchants, but also because they want to have certain investors invest in them. They want money, as do the creators that they're ironically disrupting by changing their whole business model. Capital can be really picky, and in this case with OnlyFans, it's very picky. OnlyFans, and it's funny because OnlyFans is the manifestation of the creator economy. Investors are signaling to OnlyFans that their business model is not investable. OnlyFans is signaling to creators that their work isn't acceptable. And similar to SPACs, it's a signal to the broader market of what works and what doesn't. And then it gets down to individuals. So humans seek to achieve three things, I think. Most of us, to an extent, like on aggregate. And I know there's gonna be people who are like, not me, I don't do that. I know, I understand. I don't think I do this either, but I do think there's like a human drive to do these three things. Signal that you're wealthy, signal that you're part of the in-group, and signal that you're somebody important. So solving for wealth, solving for community, and solving for status. We are increasingly melding into this ownership economy, which is really a bunch of little economies all strung together. And the key thing in an economy, funnily enough, is who can flex the hardest. Humans have been flexing since the beginning of time. I'm sure the first guy who made fire, everybody was like, dude, you don't need to be flexing on us that hard. Like, stop. And Packy wrote a really good piece on the narratives that we tell ourselves. Of course, we humans have relied on stories to carry our culture into perpetuity. Like, that's just how we operate as a species. But the question becomes, like, as our communities become more and more decentralized, how do we continue passing on those narratives? What are the fundamentals of community structure? What does it really mean to be a part of the in-group? And how do you signal this and all the above to the others in a way that, because we don't exist in these like communities right now, we exist in these decentralized communities on the internet. We operate asynchronously, so our internal pricing structures have to reflect that. Okay, and what are you saying, Kyla, right? Like, what am I saying? Basically, we are communal, so we rely on stories to tell our story. We are increasingly decentralized, so we rely on the internet to distribute our story. And then we rely on tokenization in Web3, specifically a fancy way of saying officializing, to enhance belonging, signaling, and collective decision-making. So we rely on those three things to distribute our stories because we can't do it in the same communal way that we've always done it. And then there's really big FOMO. So Justin wrote a really good piece here about how the roaring wave of success seems to touch everybody except for you. Not you though. Everyone is creating except for you. Everyone is making money except for you. Everyone has a community except for you. And 2 p.m. wrote a really good piece about FOMO culture here too. FOMO is manifested through this social signaling, so I have this and you don't. And the key ingredient to any social club is this aspect of FOMO. It's a digital country club. Basically, if you want to flex on everybody, you should have a penguin as your PFP on Twitter. You have to have a way to signal to everyone else that they should have FOMO about what you're doing, and that comes through these Web3 things right now, because they're the only way that we can signal status and wealth and whatever in this decentralized society. Arthur Hayes wrote a really, really good piece about this that goes way more in depth, and highly recommend that you read it. Flex goods are a combination of scarcity, so I have this, you don't. Community signaling, I'm a part of this, you're not. Seemingly worthless or could be replaced by something much cheaper, I have wealth. So they solved for that above equation that humans want to solve for. Flexing is an integral part to the human experience. We don't question the value of physical meat space items used to protect social standing. We understand and value fashion, paintings. We all don costumes at work that illustrate which professional community we belong to. The costume is part of the self-worth, and that now comes through these Web3 items. Signaling. You want people to know that you're that person. And that all integrates into the broader metaverse as we continue to inch towards the future that Zuck has outlined for us. How do you flex in the virtual world? How do you signal that you're rich and famous and cool? And that's what we're all trying to figure out right now, is this aspect of signaling. Right, so this probably seemed like a bunch of random ideas, and I'm going to try my best to tie them all together. We all want to signal that we're part of something bigger, and that we're part of something important, that we have wealth, that we're a part of a community. Hey, what's up? It's Editing Kyla. So a lot of other news came out about OnlyFans, and it's really being focused on the card payment processing companies. I was really focused on the Axios article that was talking about investors. I think that there's a lot that's going to surface out over the next few days, weeks, months, however it be with OnlyFans. And I was really focused on the investors here. This is probably not going to be evergreen content because of that. But yes, it all boils down to signaling. That's the main thing. And that bleeds up into what Amazon, the SPACs, and OnlyFans all want to signal. So, well, Amazon is just flexing on us. They really don't need to do physical retail stores. SPACs and OnlyFans do have to warp their narratives to meet investor demand, to signal wealth, to get money. Individuals accumulate virtual goods right now in order to signal wealth. And in terms of the end group, Amazon can now be reached beyond the confines of the web. So you're able to aggregate actually in a physical space with Amazon. With SPACs, they're designed for the everyday investor, but only benefit those OG investors. You can only be a part of the in-group if you're very rich with SPACs. Honestly, you probably only make money if you're very rich with SPACs. You're part of the in-group of the SPAC world. And then with OnlyFans, they created a lot of access for their creators. They showed their creators that they could be a part of this exclusive community of people that are able to execute upon this sort of work. But now they're showing that those creators are not a part of the in group, that those creators aren't quote unquote good enough for investor money. And they're showing to investors that they're willing to sacrifice, OnlyFans is willing to sacrifice their business model to meet investor demands. And individuals were using goods as a way to signal community and that we're a part of something. So having a penguin as your profile picture on Twitter. And then the final variable of how do you signal that you're important? Amazon is basically like, we can destroy you and then become you, like they did with malls. SPACs, we can make you a lot of money, but only if you're early. OnlyFans, we can change our business model to fit in. And then individuals, I can flex pretty hard because I have a ton of NFTs and a lot of virtual money. So essentially, okay, so a lot of this, it seems pretty abstract. So there are these key tickers that I described to FOMO and signaling and status. And that's what SPACs and Amazon and OnlyFans all represent. And the key thing from an investable perspective, so how do you put this into practice, is staying true to your own vision. So I really, really wanted a penguin. But I can't go throwing around penguin money. I'm just not. I wasn't that early to crypto. It would have been getting caught up in the FOMO. It would have been a way that I was trying to signal to people that I was in crypto, that I was a part of this community. But I was trying to meet a narrative that wasn't designed for me. And it's a lot better for me to go and do something that I'm more suited to and invest in something that I know a little bit more about. The products that we build, the things that we invest in, will always have a signaling aspect. Because finance is culture. I'm going to talk a lot about that moving forward. There's its ownership economy. We want to own what we invest in. And so finance is increasingly becoming a culture and how you represent yourself to the world. There's always a psychological game. When you think about this FOMO and signaling, can OnlyFans have a business structure and have user base? They don't have a business model. No. Will Amazon succeed at physical stores? Or probably. Are SPACs good? Most are not. Do I really need a penguin that costs 4x my rent? Nope, not right now. So it's important to just watch these traffic lights of signaling as we sort of move through this financialization of culture. Make sure that we understand how they direct our behavior, because the green light doesn't always mean go. I hope that made sense. Thanks for hanging out. Thanks for chilling. As always, it's super fun. And let me know if you kind of like these more meta pieces. I really enjoy doing them. And because like for me, I love like connecting the dots between random ideas. So let me know if you vibe. And yeah, no, thanks for hanging out, and I'll see you very soon. Weekly market update will be back once I am more stable in terms of where I'm living. So yeah, thanks for hanging, thanks for chilling, and I'll see you soon.